There's been a monumental shift in the real estate game recently. Recent data from Redfin reveals a jaw-dropping 45% plummet in investor purchases over the past year. We're talking about the biggest dip since the infamous 2008 crisis. Cities like Charlotte are witnessing a whopping 60% drop, Atlanta's down 64%, and Las Vegas has taken a colossal hit with a staggering 65% decline. In fact, they've sunk so low, they're now below the levels we saw back in 2017. Why is this fantastic news for you? Well, dear regular homebuyers, you'll face less competition from those big-shot Wall Street investors. Why, you ask? Because in 2023, it just doesn't add up for them. Rising interest rates, soaring rental vacancies, and falling rents in certain markets have left them scratching their heads. According to the latest figures from Apartment List, rent across America is down by 1.2% year over year. Hold on, it doesn't stop there. A whopping 72 out of the 100 largest cities have witnessed a rent decline over the last year. The most significant drop? That's happening in sunny Oakland, California. Sure, these are averages, but take a peek at Zillow in your local market and you'll see investors struggling like never before. Before I reveal the stats, please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far, as each like and subscribe is fuel for the algorithm that helps support this channel. Thank you. Now, back to what I was saying. If you happen to be in Nashville and decide to explore the southern part of the city, you'll be greeted by an overwhelming sight of numerous rental properties. Seeing the sheer number of houses and townhomes available for rent in this area alone is astounding. In fact, if you zoom in on certain neighborhoods, it becomes apparent that almost 1/3 of the houses are up for rent. As you delve deeper into the rental market, you'll notice that many properties are managed by big players like Progress Residential, known to be Wall Street landlords. These companies play tricky games with the rental rates, often raising them by a staggering 40% and then bringing them down by 30% in a seemingly random pattern. They might increase the rate by 1%, followed by a minor uptick of 0.2%, and then reduce it as they see fit. The current situation is that many Americans are grappling with a serious crisis regarding the affordability of rental properties. Regrettably, the rents have skyrocketed, so most renters find it impossible to bear the cost. This has led to a major dilemma for people renting from Wall Street landlords, as they are witnessing their houses remain empty and unoccupied. Consequently, most of these landlords have stopped purchasing new properties. However, there is another pressing issue that has not been given enough attention. This problem arises from the steep rise in mortgage interest rates. Recently, there has been a significant surge in interest rates for potential home buyers, which has created yet another obstacle for them to purchase a house. The widening gap between mortgage and cap rates creates a problematic situation for landlords. They now operate in a market with stagnant revenue streams while their debt financing costs have increased sharply. Given this challenging dynamic, landlords must find innovative means to increase their rental revenues and/or lower their borrowing costs to remain profitable. According to a recent analysis, the average return for such investors has been a mere 4.6%. This means that the income generated through the property is only 4.6% of the purchase price, significantly lower than the current cost of debt. In a nutshell, this situation implies that anyone buying with debt is essentially losing money. This is especially troubling since most Wall Street investors utilize this buying mode. This issue is not an established norm in the market, and it only became prevalent recently. Before 2022, the income of a property would generally exceed the cost of debt. This ought to be the norm since it would incentivize investors to buy real estate. For instance, if an investor could purchase property with a 5% cap rate, while their mortgage rate was only 3%, it would be profitable. During the pandemic, this is precisely what investors did. There was a high demand for properties in this range of profit. However, the current market examines a different ballgame for various reasons. If we want to attract investors back into the housing market, there needs to be a significant increase in cap rates. The truth is that investors will only come back if they can receive a 6 or 7% return when they buy real estate. There are only two ways that cap rates can increase. Either rent prices increase or prices for homes go down. The issue with rent prices is that they are currently fluctuating so much. That means that the only real solution is for home prices to decline. As things stand right now, that's the only way to return yield and profit to the housing market for investors. Cap rates greatly impact the housing market because they essentially measure the expected return on investment for a property. In other words, if cap rates go up, the attractiveness of a given property can decrease due to the increased risk. Undoubtedly, the housing market has been struggling over the past several years, and a key factor has been the lack of investor activity. Many investors have hesitated to return to the market due to the cap rates, making buying property less attractive. Let's revisit the 2008 financial crisis and its impact on the housing market. As we're aware, investor purchases peaked in late 2005, but during the crisis, they plummeted, much like the current situation. What's interesting to note is that during the last downturn, home prices didn't collapse until 2008. 3 years after investors began bailing out. This serves as a telling indicator of our current housing cycle. The current state of the market is not entirely comparable to the last financial crisis, as the underlying causes and circumstances are different. However, we can still glean some valuable insights from the past trends. At this point, it appears that we're in the midst of a similar investor crash and a decline in purchases. While there may be some differences compared to the last downturn, one thing is clear: home prices are likely to take a hit. It's difficult to predict precisely how much of a decline we'll see and when, but looking at past trends and considering the current market, it seems prudent to prepare for some level of downturn in the coming years. As of now, we're approximately 12 to 18 months into the current economic downturn. Although we've started witnessing a decline in property prices across different regions of the United States, prices are still significantly high overall. However, this timeline for the current housing market follows the pattern of previous downturns in the industry. We need to observe a certain trend among investors before we can expect any substantial price drops, which could be as significant as 20 to 30%. Investors must stop buying and start selling properties in large numbers. Unfortunately, we haven't yet seen such a trend in this current housing market downturn. Experts believe we're still not close to reaching the bottom of the housing market crisis. We may continue to see fluctuations in property prices in different regions as the nation navigates through the current economic turmoil. According to data reported by the Pew Trust and originally gathered by CoreLogic, as of 2022, investment companies take up about a quarter of the single-family home market. Specifically, investor purchases accounted for 22% of all American homes in 2022. It seems that these investors, along with homeowners, are holding tightly onto their properties despite the housing market's current state. Despite the downturn in the housing market and decreasing rental prices, investors appear to be confident in their ability to profit from house flipping. This involves purchasing a property at a low price and then reselling it for a profit without making any significant renovations or improvements. Unfortunately, this strategy may prove to be problematic for some investors. One significant issue is the property's vacancy. As houses sit empty, investors incur various expenses, such as property taxes, insurance fees, and mortgage interest, if applicable. These costs can quickly accumulate, creating a financial burden for the investor. When it comes to predicting how the housing market will behave during a recession, it's hard to say for sure. With still many investors buying up properties, we don't have enough historical data to predict accurately. The problem lies in the fact that as more investors buy properties, more people own homes they don't actually live in. This means that more people own houses purely for speculation. As a result, if there is a major economic downturn or if the rental or housing market takes a big hit, this could have serious implications for these investors. Without a steady stream of rental income, investors could be stuck with properties they can't sell or rent out at a reasonable price. This is not just a mere inconvenience, but a huge setback for people trying to find a home. The rise in interest rates makes it increasingly difficult for them to secure a mortgage and thus own a home. It is a complex and multifaceted issue affecting the American economy and the housing market. Hence, it is high time that we address this problem head-on by working together to bring about an effective solution. This uncertainty can be unsettling for buyers and sellers in the housing market. However, there are steps that you can take to mitigate your risk and make smart investment decisions. Thanks for watching, and please make sure you subscribe if you enjoyed the video and leave a comment below letting me know what buying and selling real estate approach you think can be a lucrative and rewarding investment strategy, even in challenging economic conditions.